And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, the whole enchilada. It's the Lance Roberts Show, presented by Clarity Financial. It's life, money, and sweat equity. Now, welcome in to the Lance Roberts Show.
Well, I'm just sitting here watching this market close out for the day, and first of all, just thank God it's over. That's the way most people feel right now. It's like, what a brutal day in the markets. Well, it shouldn't be surprising, first of all. We've been talking about here for a while that the markets were, flirting up here with all-time highs, but despite the fact that markets were performing, well in terms of earnings and the economy, what markets weren't doing is markets really been struggling to really make any advance over the last couple of weeks. And because of that, really set the markets up here for a bit of a corrective action. That's what we saw today. And again, not surprising also that coincided with the fact that interest rates snuck back up here above 3%. So over the course of the last really about year and a half, every time rates have gotten above 3%, not immediately, but well, within a couple of weeks or a month, we've seen the markets really begin to struggle because when yields get above the average earning yield of stocks, well, there is an alternative. This has been one of those markets that have been classified as a TINA market. Right? There is no alternative. Interest rates were low and suppressed by the Federal Reserve, so there was nowhere to put money except where? In stocks, of course. Stocks have the most risk, but that was considered to be the alternative to cash. Well, all of a sudden, with the Federal Reserve hiking rates, we're now above 2%. In fact, money markets are yielding 1.5%, 1.75%, 2% interest. So there is an alternative to stocks, and every time rates get above 3%, well, money's rotated out of equities and have looked for another home. And that's what we saw here really over the course of the last few days. The fact that markets have not been able to rise has been a function of the fact that interest rates have been rising. And that's really beginning to cause some concerns about some of the areas in the economy. September auto sales just came in, a very, very weak level of auto sales in the month of September. Why? Not because people are just deciding not to buy cars, but people buy payments. And for the last several years, it's been a function of buying cars has been low interest rates and extending out the payment terms, 6 years, 7 years, 8 years. How? To get that payment low enough so that people with very little credit and very little cash, which is a vast majority of Americans right now, could actually afford a car. Same thing with home prices. Home prices have been going up, but notice that since interest rates have really started rising in the course of the last 12 months, existing home sales, new home sales have started to decline, particularly on the coast where you've had the largest price advances. That's a function of interest rates. Why? People don't buy houses, they buy payments. So when the payment gets above the level that they can afford, they tend to curtail their activity. But let's talk about interest rates where we are currently, because the big question is now is, well, interest rates are obviously going to the moon, and the reality is no, they're not. So first thing here is this is the S&P 500. Let's just take a look at where the action finished up today, just to put this into some perspective, because this has been one of the big concerns today is that the markets are crashing. And of course, immediately the first day you have a down day, there's already articles kind of slattering all over the web right now talking about this is the beginning of a 20% correction or whatever it is. It may be, but we're far from having any type of acknowledgement that that's actually occurring. If you're watching our live stream right now at our YouTube channel, Lance Roberts Show on YouTube, or on our live stream channel, of course, you can get all of our live feeds directly off our website at realinvestmentadvice.com. Just click on the podcast tab. What you'll see here is that the markets are currently flirting around where we were when we broke out of this market back in January. So in January, we hit a high of about 2860, 2850, 2860 on the S&P. We came and broke above that back here in mid-August. We've been above that. This sell-off today is still simply well within the context of just a pullback and a retest of those January highs. We haven't really done or violated anything of consequence at this point that as a longer-term investor and from a portfolio management standpoint that I would want to be concerned about today. However, there is some reasonable consideration to look at here. This high back in January, this high that currently happened in September, October, depending on where we go next, could be indicative of a larger topping process in occurrence. And this is the same type of action we saw back in 2007. Also the same type of topping action we saw in 1999 and 2000. So again, don't dismiss this activity as simply being a one-off sell-off. We've got to watch more of this develop. But importantly, it certainly doesn't say anything today, at least this week, of any major consequence. Now, I'm going to be doing a lot of analysis on this weekend. It'll be in our newsletter, so make sure you subscribe at our website, realinvestmentadvice.com, to get our latest newsletter. We'll email that to you this weekend. But let's take a look here specifically at interest rates, because this is the big question. Interest rates have come down here. As interest rates go up, bond prices fall, and so when we start talking about bond prices on the 10-year Treasury are back to some of the recent lows. And when we talk about where we would expect things to go to next, here is a couple of things to think about. Interest rates, just like the stock market, get overbought and oversold. Interest rates have been rising, which means that bond prices have been going down. Currently, bonds are more oversold today than they have been at just about any other juncture in short-term history. In fact, every time bonds have been this oversold within the last couple of years in particular, we've seen bonds actually have very nice rallies from here price-wise. So if I was looking for a place to put money to work, I would be looking for some bonds right now because, again, just looking at very oversold short-term conditions, this is a reasonable opportunity to add fixed income to a portfolio. Let's step this out a little bit further, look at a weekly basis. This takes our time frame back about 3 years. Again, when we look at a weekly basis, now we're slowing down the movement of interest rates. Interest rates are now at a level, in other words, bond prices are now oversold enough that you've got bonds more oversold today than they have been at any other point in the last 3 years. Again, going back and looking at bond prices and interest rates, well, anytime bonds have been this oversold, this has been a good opportunity to add fixed income to your portfolio. Let's step back this further all the way to 2009. This is the height of the financial crisis, taking a look at interest rates. And what we find here, again, bonds now on a monthly basis, going back to the financial crisis, have never been this oversold except when we were in the middle of the financial crisis. So taking a look at this also suggests that we are likely at the limits of where interest rates are going to go currently, because one of two things is going to occur. Either interest rates are going to break something in the economy, or we're going to see a rotation in the markets from equities into the safety of fixed income as other situations occur in the market. So again, keep a watch on this very closely. We are not at the point right now of any major concern. Again, the big issue here for the markets is going to be whether or not that markets can absorb higher rates and we get a stronger end of the year tick up in economic growth. I think that's becoming more suspect, because with rates rising, that is a process of slowing economic growth, extracting liquidity from the markets. So bonds may very well be telling us something about the future of the markets here over the next several months. That's the message that I'd really be paying attention to. Quick break, we're gonna come back. John Camarianos, our analyst and advisor here in studio with me. Also, we have a special guest talking about real estate. And we'll talk about the impact of interest rates on real estate. That's coming up next right here on the Lance Roberts podcast at realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.